From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 10th, 2025. Here's what's happening. The Brewers' playoff run continues this Saturday with the Cubs. The Packers are finally back at Lambeau with Cincinnati. And here are some events that are just a little closer to home. There's the hilarious Milwaukee Comedy Festival this weekend. On Saturday, you might like Flannel Fest on South Water Street. You can never have enough flannel. Or you can check out the Milwaukee Public Market. It's their annual Harvest Festival. Okay, let's get started. In England, this is the 46th annual Charming Earthworm Championships. It's the town Super Bowl. Well, every year the town of Cheshire turns the art of charming worms from the ground. It's like snake charming, but on a much smaller scale. They do it armed with French horns, pogo sticks, and pitchforks, etc. It's simple to you. Whoever charms the most worms in 30 minutes wins the brass worm trophy, and you get your picture on the paper and bragging rights for a whole year. And I can't make this stuff up. Well, we're back in England for this headline. The National Health Services remove a controversial report that on the benefits of marrying your first cousin.
Oh, my God.
They got a lot of public backlash on that. And from Florida, a Florida woman was arrested Monday after stealing a motorized shopping cart from a Publix grocery store. She was pulled over on the Tamiami Trail, a mile from the store, but she did offer to fill it with gas. There's just one problem with that. The carts are all electric. Nice try, lady. On the podcast today, we have Art Rothschild, Dave Sandstrom, and Joel Dresang. And wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A good week turned into a tough week. The NASDAQ down 2.5% this week, down 576 points. The S&P down 2.4%. And the Dow Jones Industrial Average lost 879 points on Friday, down 2.7% for the week. For the year, NASDAQ still up 15.6%, the S&P up 12.5%, and the Dow up 8.3%. You know, Joel, I think a big part of the noise coming into the week was just what we'd have in terms of economic data. Almost a waste of your time to bring you in this week, as we still have a fair number of reports in the economic release this week that we're just not getting data for because Bureau of Labor Statistics is closed, the government more broadly is shut down. I guess what did we learn this week, and what should we have learned this week that we didn't?
Well, one item is that we learned that apparently not all of the Bureau of Labor Statistics is off. They've called back some of the workers so that they can put out the report on the Consumer Price Index, which we've explained before is where we get the number from, where Social Security gets the number from for deciding what the cost of living adjustment will be in 2026. So that report was scheduled to come out October 15th. Apparently all of the data is collected for it already. So the government brought back those workers needed to process those numbers and to analyze those numbers so that they can put out the report, which will show inflation, broad inflation for the month of September. And now that's expected out maybe later this month. The latest number that you told me before that you heard was October 24th, but it's conjecture because there isn't anything official to say that. I think we'll just wake up one morning and that number will come out. But that October 24th is an important date because it's not that long after October 15th, but it's also before the Federal Reserve has its next policy-making meeting, so they would be able to use those numbers to help decide on the next rate cut, whether that happens, how big it is, how often they have more rate cuts. It's also something I read said that Social Security is supposed to, by November 1st every year, announce that COLA, that cost of living adjustment. So people who are receiving Social Security benefits probably want that time to figure out, to plan their budget for next year anyway.
Yeah, we've got a lot, I think, of just uncertainty that continues to hang. And what's interesting is, you point out the data's there, right? That it's not as if this activity isn't happening. It's not as if the data wasn't already collected. We just need the folks to come in and crunch the numbers, maybe we could throw it all into a piece of artificial intelligence and see what it comes up with. This probably isn't the time to test that theory, though. And so, critical for us to be able to operate, for us to be able to kind of get a sense of where are we and where is this headed, that we have enough of those workers to get it done. We did miss a trade deficit report this week. We missed initial claims for unemployment, but we got some information at least on kind of how the consumer feels.
The Federal Reserve is still working. So they put out a report on credit card debt, and that's usually seen as a sign of the confidence that consumers have in spending. And as we always point out, consumers drive 70% of the economy. So the report that came out on Tuesday looked at the month of August, and for the third time in 4 months, the credit card debt declined. Now, you can interpret that different ways. Some of it could be that people are just, they're well off enough that they don't need to borrow more. But it's often seen that if the people get conservative with their credit card use, that's a sign that they're just not that confident in spending. So those reservations can have hiccups for the economy larger. And then we also got consumer sentiment numbers, and that's from the University of Michigan, which isn't furloughed. And they came out with those numbers today, and it's an early look at October sentiment, and it's still pretty dour. It's consistent with what it's been lately. It's not as bad as it was in April when there was all sorts of concern about the tariff announcements, but it's down 20% from what it was a year ago. And consumers are complaining of high prices, and they're also concerned about the decline in the job market, and those don't bode well for their spending.
I think all fair concerns, and yet, Art, despite the little bit of bad news we did get and all the news that really we haven't gotten because of this shutdown, the decline this week wasn't about all the people not working in the government. It was maybe about some of what we actually got out of the government. An announcement on Friday that kind of sent the market into a tailspin.
Yeah, all of this data, like you said, that we're not getting really doesn't make any difference if China all of a sudden ups the ante in the trade war by indicating that they're going to, put in significant reviews of any transaction involving rare earth minerals. There's such a small exception that for the most part they're saying we're going to start controlling it again. Just 2 weeks before Chairman Xi and the president were supposed to be meeting, to which the president lobs back, fine, we'll just increase our tariffs. And so it's been months really since the tariff thing blew up. I mean, Liberation Day was in April. We had a roller coaster ride that month. But since then, we made money every month since. And we're up 15% for the year on the S&P 500 to start the week. So a little bit of excitement this week caused by this tit-for-tat thing between China and us. But it seems like deja vu all over again. And the markets, I think, justifiably sold off. We're overdue for a correction. Volatility's increased. If you're a long-term investor, you take this with a grain of salt and move on. So I think my assumption is this is going to be just a little bit of drama, and that both participants will come up with an opportunity to reach an agreement on something that'll send stocks higher. That's my belief. I don't know if it's going to happen that way. But a little bit of excitement, to end the week. Still up 12.5% on the S&P. We're up 15% to start the week. It's a tremendous year, despite one little day of volatility. Big deal.
Yeah, volatility centered around trade again, and I think there was some hope potentially that we could get some clarity on what global trade was going to look like. A strong reminder that the last time we went down this path in the prior Trump administration, it took a year and a half alone just to get a trade agreement between Canada, Mexico, and the U.S. We're talking about deals now with the entire world. And so to think that we were going to have them in a few months probably was short-sighted. Add in that we have a Supreme Court decision here now due in November over the legality of some of these tariffs. And I think it may be a little while longer before we have clarity. I think once we get that clarity, it becomes a little easier for countries to kind of sign, well, I'm just going to do what this country did because it seems pretty fair. And I think that will help kind of businesses free up some of the cash they need to be spending right now that maybe they haven't been. That's certainly been a part of, I think, what has driven some of the labor market concern and economic growth more broadly. But to your point, we are still up considerably. And Dave, for investors, especially investors that look beyond just the stock market, not only have they seen those strong returns in their portfolios from the equity, but it's been a year in which balance has actually been a pretty powerful tool as well.
Yeah, Kyle, phenomenal performances this year from the bond market, especially taxable bonds. I mean, we started the year about 4.5 on the 10-year Treasury. We closed this week down to about 4 even. So it not only have we been collecting some pretty attractive coupons, we've also gotten a really nice bump in pricing as rates have come down. So significant gains on the bond side. You know, we talk a lot about balance and how critical it is, and I think it's important. Just seeing some articles this week in the media, just reaffirming how strong and how valuable a 60-40 portfolio can be for you over long periods of time. We talk about how you get protection on the downside by having some non-correlated asset like bonds in the portfolio. And you got to remember, there's something called volatility drag that we refer to that refers to, if you're down 10% and you go up 10%, you're not back to even. You got to remember, you're still down 1. And that magnifies the deeper the loss. If you're down 30%, by the time the market's back up 30, you're still down 9. So that shows you have to avoid those deep losses. And a balanced portfolio will do that for you. Historically speaking, it's been a rarity where you've seen any kind of those types of extreme losses when you've been allocated to a 60-40 portfolio.
And I think the benefits of interest rates that have come down a little bit, especially recently, really further driving home the benefits of that fixed income portion of the portfolio. It was not all that long ago, go back to 2022, and how many investors felt so burned by their fixed income exposure. They felt like maybe the role that bonds play isn't what it used to be. And I think, Art, a lot of that had to do with the environment we were in then compared to the environment we were in now. It said nothing of the long-term role that bonds play and everything about maybe where we were coming from. I guess the piece that's left for us is how do we navigate, especially the fixed income market, in a world in which there's more uncertainty? What role does it play for investors now?
Bonds always play a role in a well-balanced portfolio. Different types of bonds perform differently at different times. So 2022, you and I have talked about this frequently, was a devastating year for bonds as well as stocks. And quite frankly, I was disappointed in that year at the way some of the bond managers didn't anticipate the increased interest rates which were going to be required from the Fed to bring down inflation. The concern was we were going to have a recession. I think that was a legitimate concern. It never materialized. But stocks and bonds and balanced portfolios, that's a 1 year in which balance was called into question. Every other day there was an article on balance failing. Going forward, I'm feeling better about the bond market. Short-term bonds have done consistently well. Corporate bonds are doing incredibly well. You can go out a little further, I think, and be relatively safe and get a better guaranteed, not guaranteed, but a better level of income, at least anticipated, in short to intermediate term bonds versus cash. We know short-term rates are going to go down, and we know short-term rates are going to go down because of what you've alluded to, the lack of statistics or the fact that there are going to be less people working. We're seeing less government people working. We have a government shutdown that really isn't affecting the market as poorly, the stock market, as poorly as it did back in 2018, the last time I can recall one of these. But I think we can all anticipate, as Joel alluded to, less consumer spending if less people are working, if inflation continues to rise. So bonds, again, will provide stability in any portfolio, and I think you can really count on them, knock on wood, this time around. So I like them.
No, I think that's fair. And what's interesting about kind of the bond conversation is that at the end of the day, it really is about what kind of interest rate can you get to own them? And part of the problem we dealt with in 2022 was that interest rate was exceptionally low. Yeah, maybe relative to history, it's not as high as it's been going back to the 70s, 80s, but it's certainly a lot higher than it was. And that makes that potential investment as part of that 60-40 portfolio that much more attractive. Dave, it's a time of year in which many of the mutual funds are soliciting proxy votes, a fancy way of saying they need their shareholders to reach out and just weigh in on voting for board of directors, voting for small changes to the way funds are run. Gotten a lot of questions from clients that are asking, is this legitimate? Is this something that I should actually respond to? The easy piece there is, yes, of course, this is coming from a mutual fund you own. The longer you wait to respond, the more they're going to reach out to you until they get enough votes. They are required to have a certain percentage of the shareholders vote before they can move on. But it's raised some bigger questions from clients about how we as their advisor, how we as their investment firm help to kind of manage some of the risks that come just from the world we live in now. And so I wonder kind of what kinds of steps you take in conversations with clients, sometimes to help protect them from themselves and sometimes to help protect them from maybe some of those bad actors that are out there that might be trying to get their hands on their money.
I always tell people, just exercise extreme caution in this environment. If any sense that something is not legitimate, it does not hurt you at all to ignore it or to at least suspect that it may not be legitimate. So I have no problem with clients calling us to verify those types of communications. I think you're referring to one recently that came out from one of the large mutual fund companies, and we did get a lot of calls on it. I'm glad that people are now in that mindset, not to just blindly click on a link, respond to an email, or pick up the phone and give somebody some information. So, unfortunately, we're in a world where we have to exercise that type of caution. So there's, we've done many articles on the website and our newsletter about how to make yourself safe, how to increase your security and keep your assets safe. But I guess it's sad to say, but you have to be fairly cautious today and just about question everything.
Yeah, I love getting the emails that say, is this a scam, right? It's not because I'm excited that, this is the conversation we have to have in today's day and age, but I think it speaks to the fact that we are trying to educate our clients, their family on here's the kind of things you need to be aware of, and here's somebody that you can count on. Ourselves, our team, those of us that kind of have a little more background in navigating those challenges, ask the question, and we'll happily look into it for you. We'll happily try to help you dissect, is this something that is legitimate, or is this someone that's just trying to take advantage of you? And so, again, can't encourage clients enough to reach out on that.
I think what's interesting or sad to say is that they become so commonplace that I think most people now are not as susceptible. I mean, I think when these really started to proliferate, 5 years ago, I think more and more people were caught off guard. But I think now today, most people have encountered these types of attempts, and they become more savvy.
Yeah, I think you're right. And of course, the more we get used to one thing, the more they try something else. And so, we are seeing more sophisticated means. We are seeing some even sometimes pretty low-tech, low-sophistication means that they're going back to because, we haven't seen this in a while. Let's see if it works again. And so I think you're absolutely right. Just the awareness piece of it has certainly been raised enough that it's less of a problem, but still something we should be talking about. Joel, we've got one more investment seminar coming up next week. Hopefully, we will have to contend with some kind of Brewers game that might be around that time. Good news for the city, I think, if we get it. But what should clients expect, since you were able to kind of sit through me spouting off for a good 45 minutes from next Wednesday's seminar?
Well, not only you, and you helped cover the waterfront of what's to be seen in investments in the markets globally as well as domestically, and talk about positioning in portfolios and all that good stuff. And then Dave was able to help people figure out what's going on with the tax situation going into next year's tax filing, and then Steve Giles talked for a little bit about what people should know about planning for their retirements and planning for the years after their retirements, and I thought that was all very helpful. It ended up being like a 75-minute session, and people seemed to go away pretty enthused.
Great snacks and coffee and drinks, and encourage you to come out. And if you know somebody that might benefit from that conversation, shoot us an email, give us a call. We would love to have you. We'd love to have you bring those people in your life that you think might benefit.
I'm always impressed by people who come and take notes, and they're balancing the coffee and the roll on their laps, and yet they're writing things down and paying attention to the slides. It's very impressive.
I did hear that one of those folks we thought might be taking notes was actually doing a Sudoku, so perhaps they're not all hard at work scribbling down the things we're saying, but hopefully I didn't throw anybody under the bus there. A pleasure, as always, to do the program for you. We enjoy doing it. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.